Hello everyone and welcome back to the channel. This is Fair Value Finder and today we're taking a look at S&P Global Incorporated, ticker SPGI. This is a company that's been on my list to look at for quite some time, and I'm wanting to take a look at it now and see if it's worth getting into and what a good price to pay would be for this stock. So right now we're looking at the summary. We can see that with a margin of safety, we'd really like to see the stock around 341. It's traded as low as 321 in the last 52 weeks and currently sits at 423. Fair value 401. High, we'd want to reevaluate somewhere around 443, and it's gone as high as 461 in the last 52 weeks. Earnings yield 4%. That's not bad. We'd really like to see it coming in with a EPS of $21. And they're projected to do $14 this year, $15.99 next year. So it looks like they'll have some time to build up to that. So prices might be a little high at the moment. Cash flows, very strong cash flow company, average of 35% yield. And that yield is the portion of their revenue that is making it to free cash. As we can see, they're typically in the 20s more recently. Previously, in 2021 and 2020, they had been as high as the 40s. But there's clearly some sort of acquisition that went on in 2022 where they completed a merger with IHS Market, and that's why you see huge jumps in some of these numbers. If we go look at the summary page, they are not growing their assets like that and their liabilities like that and their share count. Those numbers are being affected by that merger. So we have to go in and actually look at what they're doing, typically ignoring that merger year. A dividend yield of 0.86, average is 0.82, so it is a bit higher than usual. A payout ratio is 43.64, so they're right about where we'd like to see a payout ratio. They're just not a big dividend stock. ROE 7.68, ROI 7.75, ROA 4.53. These ROE and ROIs are not bad. We would like to see them a little bit higher. Return on equity is definitely nice because they're low on debt compared to their assets, and that's a pretty good return. Their assets are not returning a whole lot for them, though. 4.33. That's definitely a metric that they could work on. Gross margins are incredible, 67%, typically almost 70. Net margin 21, typically 29.5. Revenue growth, again, we see this huge spike from that merger, but analysts are projecting around 7% going forward. So we're going to put 7 for our thesis, and you can see right here that in 2020, 7.4, and then 8.3, 11.2, 12.5, and they're expected to do 13.4 this year. Earnings per share growth, we see declines previously, but they're expected to increase pretty well going forward. And again, looking here, 2023 was one of their lowest years that we see in our time frame here. 9.71, 12.56, 10.25, 8.25. Analysts are expecting a much better year this year. Cash flows, their cash flows have essentially been flat for quite some time. And we can see here there was a dip in 2022. Could have been something to do with that merger. It could have been something to do with that merger. But aside from that, it's pretty much a flat graph. Share count, this 10.14 is strictly off of that merger. They had a lot of shares issued. 241, 241, 329, 322. So they are starting to buy back shares a little bit. They hadn't done so in the past, but it's a pretty negligible amount. So they are buying back shares. We can say if they buy back 1%, how that changes our thesis. Assets and liabilities, again, the same thing. In a standard year, they're growing their assets about 15 and their liabilities 3 to 4. Dividend growth, they are slowing down. They came through this year with 1 cent per share dividend raise. So a little over 1% since their quarterly dividend is just shy of $1. We'll see how that plays out. But right now, they're coming through with 1% on this year. Let's say 1.1, make it a little bit better. And then the margins, they did have kind of lower margins this year, so we could say that they get it back up to their average faster. And what would we be looking at? And this is what we'd be looking at there. So the purchase price of the current share price, the fair value in 3 years is looking to be around 448 based on this thesis. So you'd be sitting on $35 in profit or 8% returns in the same time frame. I say SPY. SPY is actually a fund that they manage and own. Would be returning about 26% in the general market. 5 years, you'd be looking at 538, about 539, $134 in returns, 32%, still lagging the market by 5%. So your average annual return is about 8.3% based on all of this. And you just need to find the right price to pay for the stock. And even the fair value is not quite the price to pay. We see 14 compared to the 26, 39 compared to the 47. So we really want to be somewhere closer to 375. That would get you market beating returns over the course of the next 5 years. A lot can change in 5 years, though. 360 gets you market beating returns on all time frames. So that's really the price that I'd be looking at trying to get in. 365, 360, somewhere in that realm for more of a value play. I do like the stock. The cash flows are incredible. The margins are incredible. Debt to equity looks really good. These returns are a little low. Dividend, I almost feel like they pay too much out in their dividend. And I'd like to see them buying back shares, which it looks like they are doing now. So hopefully that's something that they continue with. So what I would probably be looking for on this stock is around 370, because buying the stock at 370 would get you about 27% over the next 3 years in growth based on this thesis, and 57 over the next 5 years. So that's a nice beat on the 5 year and almost in line with the markets over the next 3. And that is what we're looking at for this one. I like the stock. There's definitely a price that I'm willing to pay for it, somewhere in that 370 range. It's pretty high right now, so I'll keep an eye on it, wait for it to come down, but things do look pretty good for it going forward. So I want to thank you guys for watching. Please like and enjoy the video, comment what other stocks to take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.